expected impacts both in the U.S. or abroad or overseas here. And I wonder through the lens of investor sentiment, Martin, maybe there are things that you know to focus on that someone who's watching this broadcast might not even think might be impacted by a story like this. What would you want people to keep in mind as we more officially pivot into the trading session here on Thursday, obviously dealing with pretty notable news with our friends overseas?
Yeah, it's a great question, JD, because there are so many moving parts. But I think the most significant, at least from a US market perspective, at least today, is what we are seeing in the Treasury bond market. And of course, that's the government borrowing costs that are basically changing every day as a result of investor perception over the strength of the broader US economy. What we have noticed over the past couple of weeks is a big jump in borrowing costs for the US government. Benchmark 10-year Treasury notes, which mortgages and everything else in terms of our consumer borrowing are built upon, have spiked to the highest level since 2008. That's a really big move and is really unsettling for a lot of investors because liquidity in that market, which is the biggest in the world, should be able to absorb the new paper that's being issued and the Federal Reserve's sale of government bonds on its balance sheet as part of its overall process to raise interest rates and slow down inflation. So we're getting those big spikes in US Treasury bond yield. That is sending out to some degree concern, not only with respect to the pace of inflation, but the prospects for growth. Very often, or at least for the most part of my career, bond yields have been the precursor for broader market direction because they are so sensitive to broader economic conditions that we see them as being precursors to faster inflation, to slower growth, and to all sorts of other troubling issues in the economy that stocks don't always reflect. So for the longest time, it was best to focus on those as kind of a beacon in the distance. And whilst we are having our nose pressed against the screen for the daily movements in the various stocks that we follow. That's not necessarily the case anymore, simply because price discovery in the bond market is so difficult because central banks are so involved in either buying or selling bonds on any given moment. And of course, now the echoes and reverberations of what's happening in the United Kingdom are affecting price discovery in Europe, in the United States, and indeed in markets in Asia as well. So the confidence that we used to have in terms of what the bond market was telling us simply doesn't exist anymore. And without that beacon, we are now at the bow of the ship and looking into darkness, whereas previously we might have had some light on the subject. So I think that's probably the most concerning condition that we're seeing as a result of these changes in UK politics.